Welcome back to this week's Financial Flash. I'm Paul Tickey, joined today by Mark Gurak, our other portfolio manager here at Styles Financial. Hello, Mark.
Hello, Paul. Today we're tackling one big question. Why has the market been so volatile so far in 2025? And what should investors do about it?
Mark, let's start with the why. What's driving all this turbulence?
It's a mix of factors, Paul. First up, trade policies. The Trump administration has introduced new tariffs, sparking fears of a trade war. These fears lead to concerns about economic slowdowns and possibly increased inflation. That's led to market uncertainty and sell-offs, especially in global industries. The administration has also been executing some layoffs in the federal workforce that has driven some thoughts of rising unemployment.
Another side of the story is the central banks, Mark. The Fed here in the U.S. has held interest rates steady at 4.5%, while Europe, China, and Japan have cut rates to stimulate their economies. That divergence is causing some of the uneasiness for investors also.
Not to mention sector-specific shakeups. The tech-heavy Mag 7 stocks have been hit hard by valuation concerns so far in 2025. Let's face it, Paul, the biggest names in the market were nearly priced to perfection coming into 2025. So with the increased uncertainty, some investors have been pulling back from high-growth stocks and are looking for safer bets.
Okay, so how should our clients think about this environment?
First, stay diversified. That's what we do in our portfolios on behalf of our clients. We don't put all your money into one sector. We allocate across different industries and asset classes to reduce risk.
We also focus on quality. Companies with strong earnings and cash flows, low debt, strong returns on capital, and solid leadership tend to weather downturns better.
And don't forget global exposure. International stocks, especially in Europe and Asia, have been performing well versus the U.S. so far this year. So we always try to keep a portion of the portfolio invested in foreign companies.
So, what's the game plan? How should investors react?
Well, importantly, don't panic sell. Volatility can be nerve-wracking. Downturns are painful when they are happening, but downturns are normal. Did you know that, on average, the U.S. markets experience a 14% downturn every year, and yet nearly 3/4 of the time, the markets finish that year positive? So panic selling can be costly, as selling at the wrong time locks in losses, and timing the market on the way back in is often a fool's game.
I'd also like to add that we will actively rebalance your portfolio. We check your allocations and make sure they still align with your risk tolerance and long-term goals.
In our efforts to rebalance, we may let cash reserves build up in accounts as bonds mature. This gives us the flexibility to buy equities at a discount when markets have given us that opportunity, like they have so far in 2025.
And of course, we stay informed on our clients' behalf. By keeping an eye on economic indicators and market trends, we can make smart, data-driven decisions.
Exactly. Market swings are normal, but disciplined investors know how to ride them out. While the markets have been volatile so far in 2025, not all the news has been bad. Yes, the new administration has been very active implementing policy changes, and this has created uncertainty. And as we have said many times in the past, markets don't like uncertainty.
But to your point, Mark, not all the news is bad. The new administration's plan of imposing tariffs where they deem imbalances exist could actually increase revenues to the U.S. government. The concern to U.S. consumers is that this will definitively lead to inflation. However, in 2018, U.S. imposed tariffs did not lead to inflation.
The administration has also been reducing costs, and in many cases uncovering some questionable spending along the way. But increasing revenues through tariffs and reducing spending should allow this administration to execute the third leg of their policy stool, which are income tax cuts. The combination has the potential to increase growth in our own economy.
That's right, Mark. And the data recently also supports a more positive outlook. Unemployment recently was reported in the low 4% range, coming in at 4.1% last Friday. This is still historically low. And before we assume federal job layoffs contribute meaningfully to that number, let's remember that the entire federal workforce is less than 2% of the total U.S. workforce. And the cuts that are being proposed impact less than 5% of the total federal workforce. Inflation also came in at 2.8% this week, a respectable level and an improvement over last month's report.
And I'll add to that, Paul. According to analytical services like FactSet Research and from the Standard & Poor's agency themselves, The S&P 500 earnings are expected to deliver double-digit growth in 2025, currently estimated at 11.6%. And this is on the back of 10.2% growth in earnings last year. The earnings growth expectations for 2026 project yet another double-digit growth year, perhaps even higher than the last 2 years with an estimate of 14.1% growth. So S&P 500 companies are healthy and growing.
Right, Mark. Yes, the start to this year has been a bumpy road, filled with ever-changing policy news headlines and market volatility. But we are optimistic that this too shall pass. We can't tell you when, but our experience with the markets tells us this is true. And that remaining disciplined to your personal asset allocation is the best way to avoid making mistakes around your portfolio. That's a wrap for this week's Financial Flash. Thank you for joining us.
See you next time.
The Financial Flash is created by the experts at Styles Financial Services, creating customized portfolios that fit your unique lifestyle and goals.